Hello and welcome to Weekend Wisdom. Today we're going to talk about buy and hold and does it still work. So grab your cup of coffee, sit back, and let's get started. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First up, don't forget you can click show more for additional information and links. Also, if you're looking for a different opinion, that of Wall Street and Big TV, please do consider subscribing. So today's topic, does buy and hold still work? What does that mean? First off, it means buy your investments, hold them no matter the circumstances, up, down, sideways, whatever the case might be. And the reason this is important because we're seeing a lot of end of cycle signs. If you haven't seen my most recent market update, we'll have a link up here. So when you talk about this, we as an industry have been spoon-fed asset allocation, modern portfolio theory. Stay the course. It's not timing the market, it's time in the market. These all sound great, but do they actually work? Well, first off, I will tell you I have changed my opinion on this. Why? Because when I came to this side of the table, meaning from the institutional side to the retail side, working with individual clients, we know that over time, generally takes 7 years to recover after a meaningful correction, like a 2000 or 2008. If you're taking income, that can extend to 12 or 14 years. That is a long time for anybody, especially those in retirement. I asked a question yesterday to somebody who's 60, and they said, no way can they handle that kind of downturn. So let's get to the facts. Okay, first up, I have a tweet here from back in May from Michael Leibowitz. Great follow. I'll have a link below. When the market does break, you may be waiting a long time to get your money back. Ignoring history, risk levels, and valuations has its consequences. He goes back to 1900, showing you 22 years of being flat, 29 years, come up, 24 years, then we break out 14 years, our most recent, and then we break out again. Now, of course, others have an opinion, right? Adjusted for inflation but not dividends. Let's give this its true name, the fearmonger chart. By the way, that's Dan Egan. He owns Betterment, so you know why he's coming out with this. Now, next up, Michael redid the chart. It really doesn't change at all. 6, 15, 12, 13 years, okay, since 1900. So that shows you the time it takes to get money back and these flat times we've seen in history. So next up, what do we hear all the time? We hear average returns, right? But there really is no such thing as average returns. I did a video against Jim Cramer. I'll have a link up here, really disputing those facts. Excuse me. They're not facts because he was wrong. So, first up, just a simple example. $100,000, 7% a year. You see where we are, $140,000. Simple math, simple compounding. But it doesn't happen like that. If you have just one minus 7%, you see what happens, and the difference is 4%, and it's going to take you 16% to get back to even. Okay, so next, the question is about timing the market, okay? And you have a lot of people that talk about not missing days, etc. So again, let's take a look. Here's your best days from 2017. 10 of the top 10 occurred in bear markets. 21 of the top 25 occurred in bear markets. 45. So does that really come into play? How about here as far as some of the bull markets? Worst 100 days. 8 of the top 10 occurred in bear markets, etc. I can go through the numbers. The bottom line is, from 2000 to 2017, 100 best days. 378.5%, 100 worst days. Now, let's take a look at some charts. Okay, first up, I'm going to go back to the modern era, 2000, right? So we know we've had this, we've gone up, we've gone down, and then, of course, we've had our big move back up to the upside. But what you see here, I'll have Andrew zoom in, minus 50%, 107% on your next move up, minus 57%, up 137%, okay? And then from here, might be tough to see, but 71.6%. So this shows you kind of the modern era where we are. More importantly, down here I have performance, 85.74. Now, wait, CNBC and everyone else says we average 7 to 10% a year. And that's what most clients will say when I ask them that question. But if you look here, we're talking about 4.46%, okay? Average from 2000 to today. Today being Friday, March the 7th, I think. I'll have to check my watch. March the 8th. All right, that's important to know. So first off, this shows you the flat periods and what it takes to come back, all right, which is an issue. So next up, I saw a study a couple weeks ago about, again, not timing, but having a process. We have a process on how we manage money, also on how and when we will get out of the market. I utilize the 200-day moving average quite a bit, and you can see it. So this came from Arthur Hill, and then I recreated the charts myself, and I'll have a link to his information below. Great technical analyst. Okay, what he shows here, what if you use the 200-day moving average of price in the S&P, obviously the broad market, use that as a guide to get in or to get out of the market? Well, you had 90 bullish crossovers, 20 winners, average gain 13.69%, 70 losers, okay, 1.32%, which isn't too bad. But the problem is you're flip-flopping a lot, right? You can see that. So then let's look at some other time frames. Okay, first off, this will show you just recently, I go back to 15, 16, and how many crossovers we've had in the last couple years. Right here in 16, that's Brexit. And right now, we had a bunch last year, and we went up, and then we're down again today. Okay, again, Friday, March the 8th. So what he does is he asks the question, he looked at a 5-day, a 20-day, and a 50-day. Now, the 50-day I talk about all the time. The 50-day moving average crossing over the 200-day moving average. That, my friends, is called a death cross. That is not good, okay? So in this particular case, he used the death cross as a guide to go in and out of the market over time. The black represents going out of the market. Yellow is going into the market. That's when the 50 goes above. That's a golden cross. That's why I have it as yellow. Okay, let me put that back on. We've had some choppy times right here. 2011-12, remember that? Pretty rough at that time. I do remember that, right? Had a little cluster right here again. That's your 15, 16. So, but overall, this is what's really nice about this. It'll show you 11 bullish signals. So we've got a lot less. So we're not flip-flopping in and out. 9 winners, 2 losers. So it tells you in and out using this 50-day moving average works pretty well. This is the S&P down here, and these are just the moving averages up here. Now, he also looked at some other factors. Let me bring those up next. He took buy and hold, 200-day, using that as a signal. Okay, then he did a 5-day crossing a 200, a 20, and a 50-day, which is our death cross, which I really focus on personally. 7.26% return, and that's from 94 until 2/1 of this year. Now what happens is the key factors here, maximum drawdown. Again, I'll have Andrew zoom in. 56.7% of the S&P at that time. Maximum drawdown, how much money you can lose at any one time. Year didn't end that, but that's the maximum. And then what? We showed it. You have to be back up over 100+%. Now, from there, what happens as you go further out, your return goes up from 7.26, the highest return over that time, 8.43 on your 50-200 day as a guide. Then you have risk-adjusted return, 11.58. What that means, it's taking all the risk factors and what you get by doing this. So basically, you're adding alpha. Alpha's return, okay? We have our maximum drawdown. We went from 56% to 20%. All right, pretty strong difference there. Obviously, you don't have to come back as much. Wins, 9, and only 2 losses. When you look at the 200-day, we had 20 wins and 70 losses. Okay, and a winning percentages, who doesn't love winning percentages? 22 on a 200-day, 82%. Okay, on the 50 crossing the 200. Average loss, it does go up a little bit to about 2.6 versus 1.32 on the 200. So, no, I do not believe in buy and hold. I think it's okay to be out of the market. You want to make money in up markets, but I will tell you, it's more important, and you see that by the numbers, to save in down markets, understanding there are no guarantees in this business, but following a process, looking at a system, and being disciplined will hopefully help you over time. Thanks for watching. Michael Loftus, Wealth and Wisdom TV.